Hello and welcome to the Weekend Investing Daily Bite of 9th of December and a sort of a dull day, I would say, on the Nifty. Market's not going anywhere. But as I'm recording this, there is a breaking news that we have a new RBI governor in place. Mr. Sanjay Malhotra has joined as the new RBI governor. He's replacing Mr. Shaktikant Das. The USD INR has spiked to 84.8. So we'll need to dig in deep as to what the market expects from the RBI governor. In today's uh, video, you will be able to have a sound discussion on are FPIs losing faith in India. We seem to have a lot of narrative around foreigners and overseas investors selling out in India, and a lot of folks are maybe reading too much into that. Let's look at some of the numbers and discuss that. Do read the disclaimer as always. Do subscribe to the channel and click on the bell notifications. Where is the market headed? So markets for the second day running a very tepid move, a small ranged candle here. You can see that Thursday was a huge move on the Nifty. And the next 2 days, that is Friday and Monday, have been sort of inside bars, and that too a very small ranged bars, kind of suggesting that the market is cooling off a bit and consolidating without dropping much. So this is usually a nice formation after a big move up, that you have few days of consolidation and then the move continuation can happen. Certainly on the charts, Nifty is looking bullish. We have broken through some major resistances near 24,500 and we are sitting on top of that at 24,619. So I think this Thursday bottom and this average that we are seeing, the 40 SMA average, I think this will sort of be the go-to point of pivoting down, if at all, if we go down, and we will continue to sort of rally up, is in my view, gradually. Nifty next 50, not half as bad as Nifty in terms of the chart, because the chart is looking very strong. The breakout happened 3-4 days back, minus 0.45% on this today, but looks quite good in terms of going forward. Mid caps even look better at 0.38% for the day. You can see how quickly they have run up and gone up beyond the previous resistances, and now about to challenge the two major resistances here and go to a new all-time high potentially. So this break of this level here was very key, and we've now spent almost 4 days above that level, so cementing reasonable strength above that level. Small caps are even better than mid caps. You can see how in a sort of a single way, one-way street, small caps have moved up. This happened earlier in June, you can see here, and then after a while there was some sort of consolidation and further move up. So this may result in a new all-time high very soon. Small caps definitely looking good at 0.37% up today. Bank Nifty, a dull day, minus 0.19%. But the fact is that on Thursday, we were expecting a good rate cut. On Friday, the rate cut didn't happen, but CRR cut was there. Banks really didn't drop off. So the expectation, which was not met, really did not result in a price drop on Bank Nifty, and that potentially is a reasonably strong signal from the price perspective. Momentum trends are reasonably, I would say, towards the green, 259 advances to 237. So almost even, uh, but not looking bad for a consolidation day. Heat maps for Nifty, you can see there's only some spots of green here. You have Wipro, you have L&T, you have HDFC Bank, Kotak Bank, and some gains of small magnitude. But larger losses you can see is right there in the top corner. Hindustan Levers, ITC, Nestle, and Tata Consumers, big losses there. You had some big losses in Tata Motors. Axis Bank also down 1.8%, and Asian Paints down as well as 1.56%. So FMCG is becoming more and more a concern, and this came on the back of a drop in Godrej consumers, and you can see that the entire FMCG basket has been just dropping. With respect to the Nifty going up, you are seeing FMCG being left behind, and I'll show you that on the chart very soon. Bajaj Holding is up 4% today, along with NHPC up 2%, and you have DMart and HAL also going up. DLF, IRFC, REC were some of the other stocks in slightly in the green. but some cuts on Motherson, Havells, Zomato, Divi's Lab, etc. And you also have some stocks that were just not responding. So public sector banks, for instance, were just about flattish right here. Sectoral trends, only one sector to talk about today was FMCG, minus 2.2% on the day, 2.5% down for the week, 3% down for the month, 12.4% down now for 3 months. So the FMCG has really been the bad boy of the club. And even for 12 months, you can see only 5.3% gain is there on FMCG counter. So a lot of stocks, a lot of portfolios, especially the quality chasers are sitting with huge allocations to FMCG. They're sitting with huge allocations to private banks, and these two sectors have combined given only 5.3, 5.4% kind of returns in the last 12 months. Whereas you can see sectors like real estate have done 45%, pharma is up 38%, public sector enterprise stocks are up 41%. So 1 year of such a bad miss where your portfolio is giving you 5%, whereas other portfolios may be up 30-40%, is a big gap that gets created. And it's difficult to then you're just chasing how to just get or to catch up to that general trend. So this whole thesis that you should sit in one sector and then just allow pain to go through as long as it does, and then maybe there is end of the tunnel at that end, which may or may not be true, because real estate, for instance, went through a 10-year drawdown. Pharma, for instance, went through a 4 to 5 year sort of a lull. So you really can't sit on stocks and sectors that are not performing. FMCG, a very nice, technically, I would say a classical chart here. You can see here, it took very nice support base at the 200 DMA in March, April, May. Then it went up. But then since mid-September, FMCG has collapsed. The results and the volume pickup in the FMCG sector, as now the results are now saying, the sort of clues about that were evident in the fall here itself, and then now once the companies have started to admit and declare the situation, it is getting even worse. So these 200 DMA this time was broken down beginning of November, and then there was a sharp pullback up, and an attempt to go beyond the 200 DMA failed there and is now coming back. So it's a very, very technically sound chart, where now if the break of the low made in mid-November uh, gets broken, then we are going much, much lower. So the first point, I think, where you can really say FMCG is trying to come out of its current pit is above the 200 DMA. So watch the 200 DMA on FMCG and don't try to catch falling knives. This would be my suggestion. HUL, Dabur, Colgate, Nestle, all down by 1% to 4% today. Stock spotlight is on Map My India. The stock was up 16% today. Very recently, this company, CE Infosystems Limited, has been in the news, where the promoter was launching another company and was having some funds invested into that entity, and the minority shareholders came out and smashed the stock down, citing corporate governance issues. And today the company has taken a decision to roll back all those recent decisions, and that the company will no longer invest in those kind of investments which are more private in nature, and this has restored some confidence in this stock. Today's discussion is on foreign portfolio investors. Are they losing faith in India? So this chart from Bloomberg and Mint shows you what net equity investments have happened in the last 12 months, less than 12 months, year to date. And you can see China has got $52 billion of net equity investment by foreign portfolio investors. South Korea is at 4 billion, Indonesia is at 1.5. India is virtually flat at $62 million, which is a drop in the ocean. But the saving grace is that we've not gone as bad as Taiwan or Brazil or Thailand or Vietnam, where there has been outflows. So we've had outflows, but net for the years to date, we are still positive. And versus other emerging markets, so China is of course at a different level, but versus other emerging markets, India still is standing at a good ground. South Korea, for instance, has done 3.9 billion, is ranked at the second point. Indonesia is doing well at 1.5 billion. So a lot of times when global funds have to allocate money, for instance, they are following, let's say, MSCI indices, and MSCI index, let's say, has a weight of 5% on India, and that global fund manager receives, let's say, $100 billion of investing, then that 5 billion has to go towards India because that is the allocation in the portfolio that he's following on the MSCI World Index, for instance. So a lot of times inflows and outflows will happen because a significant part of these institutional funds are following certain global indices where India's ranking, is there. And so if, let's say, 100 billion come in, we get our share. If 100 billion goes out, then that has to go out of India, and that's somewhat the reason also why we've lost some money this year, is that India specific funds also have gone out. And additionally, there has been more regulation around the KYC of foreign portfolio investors, and some sell off has happened due to that reason as well. It is not so. There is a lot of narrative that is going around in the markets that FPIs are all going towards China, and they're going to withdraw from India, and there's a shift of global capital. Uh, while there could be some inflows and outflows due to relative valuations, but India is like that, you know, uh, quality stock, you can say. Like for instance, I mean, there are FMCG stocks at, even after this drop, they are at maybe 50 times earnings, 60 times earnings. So there are these certain stocks that you can't really ignore. There's a Tina factor. There's no alternative. I mean, if you have to invest in FMCG, in a growth economy, in a emerging market, you'll have to invest into India. You'll have to invest in those companies. So this is sort of that kind of a situation where some hot money can keep coming in or going out, but this serious money that is there for 10, 20 kind of years is not going anywhere from India, and that is the situation. Nifty for this year is of course, in terms of the list of the Indian performance versus others, reasonably high, I would say. Um, uh, the the year to date return in certain markets have been amazing. 29% in Taiwan, 27% in S&P 500. So most of these developed markets, so DAX, Singapore, Nikkei, S&P, they have done well, and that is also causing some shift of funds from emerging markets towards developed markets. But I think once Trump comes in, and there is movement on the US dollar term, because Trump wants to have a weaker dollar versus the rest of the world. The rest of the world wants weaker currencies versus the dollar. So there is going to be a currency war of sorts, and that probably will also determine how these flows will happen in the coming times. Of course, on a PE ratio basis, India is reasonably expensive versus other emerging markets. But if there are only a couple of markets which are really growing, then India at 20 times also is not such a bad option for a lot of investors. DIIs, of course, have taken lead in the last few years. You can see the numbers, how large the numbers have been for DII domestic investors. And it's only in this year where you have very, very small outflow, or the number for FPIs for 2024, virtually uh, a zero position for that. And that has more than been compensated by the huge inflows from domestic investors. So there's a very nice balance of sorts that is available there, and that probably is sort of situation where we saw in 2015-16, after which markets took off till 2018 when there was a crackdown, and then again it took off till 2020. So I don't see a reason why FPIs will not come back after maybe a year of such flattish performance, and maybe another year or so as earnings also catches up to the current situation. So the point of high price earnings being a concern, yes, it may be a concern for a lot of investors. But again, I mean, a lot of investors are not just value investors, or doing price earnings based investing. So it cannot be singularly used to judge whether we have top or bottom. A lot of inflows and outflows determine whether the funds are coming towards India or not. I think domestic flows and any change in certain tariffs that Trump, or the new changes that they may happen, if they do benefit India, you will quickly see a lot of funds again revert to India regardless of valuation. So that is something that a lot of times will happen, because the liquidity flows, if the market has liquidity and the market is going as per certain global indices, that liquidity will flow regardless of the valuation. And that probably is happening in a lot of sectors even today as we talk about. If you will go ahead and see a lot of the high flying stocks, you will find that you cannot justify them basis any earning, but that does not mean that the price is not going up. The stocks have gone up 5, 10, 20, 30, 40 times in the last few years, and if you had the singular sort of metric to judge them, you would have missed the boat. So this is how the markets are currently placed. What is your view about the markets in the coming year? Do share with us in the comment section, and we will have a nice discussion there. Thank you so much for watching this Daily Bite. Do like and share these videos with your friends and colleagues, and do subscribe to the channel. Thank you. Bye bye.